Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Hello and welcome. Today we're doing a deep dive into the U.S. market analysis for Monday, April 6th, 2026. We're going to unpack all the key drivers, everything from the geopolitical situation that has investors on edge to some really crucial economic data that's got everyone hitting the pause button. And just a quick reminder, this presentation is a direct informational narration of the source document we're analyzing. So let's get started with the important stuff first, the risk disclosure and notice. It's really important to remember that this is for informational and research purposes only. Investing in the markets always involves significant risk, and that includes the potential loss of your principal. So nothing here should be taken as financial advice or a recommendation to buy or sell anything. Ultimately, all investment decisions should be made independently by you. Okay, here's our game plan. We'll kick things off with a current market standoff and the big geopolitical cloud hanging over it. Then we'll dig into some macro data and zoom in on a specific sector. From there, we'll assess a few key stocks making waves. After that, we'll look at the quantitative and fund flow side of things. And finally, we'll wrap it all up with some closing thoughts and a pretty serious warning. All right, let's jump right into our first section. The market right now is in a state that the source document calls strategic hibernation. What does that mean? Well, the big indexes are kind of treading water, but trading volume has just fallen off a cliff. Now, this isn't necessarily a sign of panic, but more like everyone is collectively holding their breath, just waiting for a clear direction. The analysis really paints a picture of an extremely fragile market. It uses phrases like a liquidity vacuum and a bull-bear standoff. Now, to be clear, this isn't about a lack of cash on the sidelines. It's about a lack of conviction, a real hesitancy to take on any new risk. And it all boils down to the geopolitical situation. And that situation is, of course, the ultimatum over the Strait of Hormuz. There's a hard deadline coming up this Tuesday at 8 p.m. Eastern Time. And if that deadline passes with no breakthrough, the analysis points to a potential 4-hour window where military strikes could begin. It really just goes to show how far apart the two sides are in their negotiations. And here's the fundamental problem. On one side, you have the U.S. demanding a short-term, 45-day ceasefire, really just to get shipping lanes back open. But on the other side, Iran is pushing for a much bigger, long-term strategic plan that would have to include things like sanctions relief. This huge gap between their goals creates a binary, all-or-nothing outcome for the market. Okay, shifting gears now to the macro data, which is showing some worrying signs of its own. The latest ISM report for the services sector, which is a huge part of the U.S. economy, is flashing some warning lights. It's pointing to what the source calls a quasi-stagflationary setup. So let's break down the numbers because they tell a pretty interesting story. The main headline number, the PMI, came in at 54.0, a little softer than the 55.0 that was expected. Business activity also slowed down quite a bit. But here's where it gets really interesting. The prices paid index, that's a key inflation measure, it shot up to 70.7. At the same time, the employment index dropped all the way to 45.2, which suggests the labor market is really starting to cool off. And this creates what the report calls a scissors pattern. You've got prices going up and employment going down. This is the absolute worst-case scenario for the Federal Reserve. Why? Because the main tool they have to fight inflation is raising interest rates, but doing that would pour cold water on an already cooling job market. It really ties their hands. And you can see this pressure playing out in specific sectors already. Take managed care, for instance. The final Medicare reimbursement rate was set at just 2.48%. But here's the thing. The actual cost of medical services is rising between 7 and 9%. That creates a huge cost gap that puts immense pressure on companies like UNH to slash costs wherever they can. All right, let's pivot and take a look at a few individual stocks that are under the microscope right now, covering both their valuation and what the technical charts might be suggesting. First up is Broadcom, ticker AVGO. If you look at its history, it tends to trade at a price-to-earnings ratio of about 18 to 20. Now, with concerns that some of its big tech customers might pull back on spending, the analysis suggests a pretty cautious approach. Using that 20 times PE multiple as a margin of safety, a reasonable zone to start looking at the stock is somewhere between $225 and $347 a share. Next up, Tesla. And wow, just look at this table. Wall Street is completely split.
You've got JP Morgan way down at $145, citing risk of an earnings collapse. Then on the complete opposite end, you have Wedbush, super bullish with a $600 target, seeing Tesla as an AI powerhouse. And everyone else is just scattered in between, from neutral to constructive. It's a huge range of opinions.
But there's another risk for Tesla on the horizon, and it has nothing to do with car deliveries. The analysis flags a potential asset rotation outflow. What that means in plain English is that if SpaceX finally has its IPO, a lot of investors might sell their Tesla stock to free up cash to buy into the highly anticipated SpaceX offering. That could create some serious selling pressure. And finally, for Intuitive Surgical, ticker ISRG, the analysis boils down to one word: discipline. The key technical support area to watch is the zone between $430 and $448. The strategy here is not to try and catch a falling knife, but to wait patiently for the stock to enter that specific support zone before considering a move. Okay, now for a look at the quantitative side of the market. See, when everything is quiet and headline-driven like this, the fundamentals kind of take a back seat. And that's when automated trading programs, or quant models, can become a real wild card, because they buy and sell based on preset price levels, not on news or emotion. And this brings us to a really critical level for the S&P 500. The range between 6,720 and 6,740 is packed with buy triggers for these systematic funds. If any good news were to push the index into that zone, it could trigger a tidal wave of over $100 billion in purely mechanical buying. Looking a bit further out, a quantitative model from JP Morgan provides a likely trading range for the S&P 500 all the way through early June. Their model suggests we're looking at a lower support boundary around 6150 and an upper resistance boundary up at 6865. And that brings us to our final section, some closing thoughts and a really important warning. The analysis is very clear that the next 24 hours are absolutely critical. That Tuesday deadline at 8 p.m. Eastern is looking like the ignition point for some serious volatility. So, what should you be watching for? Well, if you start to see a pattern of gradual delays to the ultimatum, that can actually be a good sign. It might mean a deal is being worked out behind the scenes. Until we get a clear signal one way or the other, the guidance is to stay defensive and keep a very close eye on that 6720 to 6740 range to see if those quant funds start to kick in. And really, this is the main takeaway. In a market that's this fragile and this quiet, trying to be a hero and make big, aggressive bets is just incredibly risky. As the source document concludes, the most prudent stance is simply to wait. Wait for the final resolution, wait for a genuine confirmation signal before making any big decisions.